Let's get talking about crude prices then. We have Manisha Gupta joining in to tell us what she's tracking within the crude prices, and she has some opinion lined up as well. Manisha.
Thank you so much for that, Icra. Well, yes, the crude prices have been very, very volatile. We saw 4% gains yesterday morning and we closed 5% on the lower side. That's the kind of volatility that the markets are dealing with right now. It had to do with the US's delayed, measured stance and statement that we heard yesterday. That really seems to have eased some fears right now and is the reason that we have seen the crude prices come back all the way from 71 plus kind of levels to 65.5 on your screens now. Well, the markets also are looking at higher supplies coming in from US and Russia. What does it really mean for the Indian markets, the kind of volatility that we are looking at, the imports that the Indian industry is seeing, and also the price view? Let's get in all of that going, and joining us for that is Ravichandran of Icra. He joins us on a phone line. Mr. Ravichandran, hi, good to have you. First of all, what do you make of the price volatility that we've seen, and what's your sense on where are we headed from here on?
Yeah, good morning to all of you. So I believe that the market will be volatile at least for the next 1 or 2 months till the entire issue is sorted out. While prices may have softened significantly over the last 24 hours to $65, my perception is that prices should remain firm, at least upwards of $70, even if Iran were to retaliate by any measure, and more could be coming in the next few days on this issue. So while prices are corrected, we should be prepared for higher prices at least in the next 1 or 2 months. Which means that India's import bill will be higher, and which could have some negative impact on the profits of oil marketing companies and various downstream chemical companies.
Mr. Ravichandran, that's exactly my second question that I was coming to. The OMCs do manage 3 months of stocks each, and with the kind of volatile moves that we are looking at and the way we've started this year, what is your sense on what kind of margins could we see? One, because of the crude volatility and higher prices, and other because of the rupee depreciation as well.
Yeah, so with regard to, we have to look at refining and marketing separately. Refining, margins, while they were pretty weak till September of this year, since then, the margins have improved primarily on account of improvement in diesel cracks and to some extent petrol cracks as well. Diesel cracks have gone up because of preparedness towards this IMO 2020 norms, and more can be expected in the near future. So that coupled with the inventory gains should augur well for the refining margins in the near term. But on the marketing side, immediately, while there may not be any hit, I would think till crude prices remain lesser than $75 per barrel, marketing margins should not be impacted for the marketing companies. Only if it goes beyond $75, $80, then there could be pressure on them to go slow in passing on the prices to the consumers. So till that point in time, I don't foresee any material pressure on the margins for the OMCs.
What also is your sense on the Indian demand going forward? Because we have seen that, go weaker rather in 2019. Do you see demand improving? That's one part of it. And the other is, even as there is this huge conflict this is going on in the Middle East and things are far from over right now, but India does seem to be in a better position, especially for increasing imports from US, from Russia and other areas as well, with the oil companies have been working on in the recent few months. One, my question is about the imports, the uncertainty and the Indian demand.
Yeah, with regard to Indian demand, while November has seen some pickup, especially on account of diesel, but with regard to if you look at the full year scenario, it has been pretty weak. It has grown only by about 2% or so. For the full year, I'm expecting only about 2.5%, even if there were to be some minor pickup in the subsequent months, which will mean 1920 will be one of the weakest years in terms of demand growth. Largely on account of weak industrial demand and the fact that there have been significant monsoons in the current year, which also disrupted the vehicle movement and various economic activities. Hopefully, all that will be off when we look at 2021. Then we should be coming back to 3 to 4% long-term trending growth over there. Now, coming to the crude supplies per se, while we do import fair amount from the Middle Eastern region, of late options are opening up for India to import from US. Already many Indian refiners have imported, and I'm sure that with the kind of pricing advantage U.S. imports offer, more refineries will be looking at that option.
Okay.
So to the extent that will diversify the the movement of, diversify the sourcing of crude. If there were to be any disruption in physical supplies from the Middle Eastern markets.
Point taken.
Okay, so that's Oil in Focus. Thanks very much for taking us through that conversation, Manisha and Mr. Ravichandran. Thank you for joining us. We will take